Nuburu Inc., ticker BUR, is currently trading at $0.28, experiencing a significant intraday drop of 10.22% on staggering volume of over 44 million shares. The stock is pinned right at its low of the day, having failed to hold its $0.30 high and is dangerously close to its 52-week low of $0.12. When you see volume like that on a sub-dollar stock, the immediate assumption is that some major news catalyst is driving the action, that perhaps a long-awaited contract or breakthrough has finally arrived. But the truth of what's happening at Nuburu is far more complex and, frankly, far more concerning than a simple press release. The massive volume you're seeing isn't a sign of sudden conviction. It's the sign of a massive, confusing, and high-stakes argument playing out in real time between what this company was supposed to be and the bizarre entity it is apparently trying to become. The common belief, the one that likely drew many investors to this name in the first place, is that Nuburu is a pure play on next-generation manufacturing. The expectation was built on a compelling technological foundation: high-power blue lasers. This technology is genuinely interesting. Unlike traditional infrared lasers, which struggle to work with reflective metals, Nuburu's blue lasers are designed to weld and process materials like copper, aluminum, and gold with incredible precision and speed. The applications are obvious and exciting. Think of the e-mobility space, where welding copper components within EV battery packs is a major bottleneck. Nuburu's technology promised a solution. Think of consumer electronics, sealing vapor chambers in smartphones, or even high-resolution 3D metal printing. This was the story, a picks and shovels play on the electrification of our world, holding a portfolio of over 180 patents for a technology that critical industries supposedly needed. That is the expectation. Now, here's the reality. If you are trading BUR based on that blue laser story, you are missing the entire picture. The company is currently in the midst of a transformation plan that is so dramatic it almost beggars belief. Nuburu is no longer just a laser company. In recent weeks, it has announced a strategic pivot into the defense and security sector. This includes a strategic alliance with Maddox Defense to create a joint venture for next-generation drone technologies. More confusingly, it includes the acquisition of a company called Orbit, described as a software-driven defense and security platform for operational resilience. This pivot is the source of the recent NYSE compliance warning the company received. Nuburu was reprimanded by the exchange for failing to properly notify them before announcing a material event, in this case a new dual CEO structure, during trading hours. That is a significant governance fumble. It suggests a company moving so fast or so chaotically that it's tripping over basic regulatory guidelines. But the Orbit acquisition itself is where the reality check gets truly severe. This transaction, the cornerstone of their new defense software pivot, was a related party transaction. Orbit was wholly owned by Alessandro Zamboni, the man who is now the executive chairman and co-CEO of Nuburu. This is a situation that should cause any investor to pause. A company, which we will see is in a desperate financial state, is using its resources to acquire an asset from its own new executive chairman. While the company states the deal was reviewed by independent directors, the optics are, to put it mildly, challenging. It raises immediate questions about whose interests are being served. Is this the best possible acquisition for Nuburu shareholders or the best possible deal for Mr. Zamboni? This single fact fundamentally changes the narrative from a simple tech story to a complex corporate governance puzzle. The puzzle deepens when you look at the company's financials. To call them disastrous would be an understatement. The financial data is almost difficult to comprehend. In the last 12 months, Nuburu has generated effectively zero revenue. Not low revenue, zero. Meanwhile, its operating margin is a staggering 140,000%. Its net margin is negative 499,000%. These are not typos. These are numbers that signal a business burning cash at a rate that is completely untethered from any commercial activity. The company's Altman Z-score, a metric used to predict bankruptcy, is deep in the distress zone. This is the reality behind the Blue Laser Promise. It's an entity with no sales, catastrophic losses, and high probability of insolvency, which is now attempting to save itself by purchasing an asset from its own CEO and pivoting into the crowded defense and drone space. This brings us to the short selling story, because with financials like these, you can be certain the shorts are present, and they are. As of the latest data, Nuburu has a very high short interest of 26.84% of the public float. That means over 1/4 of the company's tradable shares are in the hands of traders who are betting the price will go to zero. The short thesis, as you can imagine, writes itself. It is based on the non-existent revenue, the incomprehensible cash burn, the high bankruptcy risk, and the highly questionable related party acquisition. These are not speculative arguments. They are facts drawn directly from the company's own filings and financial statements. For those betting against the company, this is not a difficult case to make. What's your take on the related party acquisition of Orbit? Is it a strategic pivot or a governance red flag? Now, many traders, especially on social media platforms like Reddit and X, where BUR has been a hot topic, see a 26% short interest and their eyes light up with one thought: a short squeeze. This is where we must be extremely careful and look at all the data. The first thing we check is the cost to borrow shares, which is the fee short sellers must pay. For BUR, the borrow fee rate is currently around 8.11%. This is elevated, showing a clear demand to short the stock, but it is not the 100% or 300% rate you'd see in a truly frantic, hard-to-borrow, squeeze-me scenario. It is a costly and persistent bet against the company. The second and more important metric is the days to cover. This tells us how long it would take for all shorts to exit their positions based on average trading volume. For BUR, the days to cover is a mere 0.33. This is the direct result of the insane 44 million shares trading today. It means that despite the high short interest, the entire short position could theoretically be covered in a matter of hours, not days. This is not the setup for a classic multi-day squeeze. The high volume gives shorts an easy escape route. What is fueling the retail suspicion is other data, specifically the high off-exchange volume, which has recently been over 50%, and the significant fail-to-deliver data from past months. In September, for instance, there were days with millions of shares failing to be delivered, including one day with over 8.6 million FTDs. To many retail investors, this combination of high short interest, high off-exchange volume, and FTDs signals market manipulation. The counter-argument is that in a chaotic, low-float, sub-dollar stock, this data is often a sign of extreme volatility and a lack of liquidity, not necessarily a coordinated attack. How can an investor act on this? First, you must understand that the squeeze narrative is on very thin ice due to the low days to cover. Second, you can find short interest data from most financial data providers, though it's typically released with a delay. The borrow rate is a more real-time actionable metric to watch. A sudden spike could indicate panic, while a steady rate, like the one we see now, suggests shorts are comfortable. Looking at the 26% short interest, but the 0.33 days to cover, do you think the squeeze narrative holds any water, or is the short thesis just too strong? So, where is the smart money in all of this? The institutional ownership data is, frankly, the final nail in the coffin for the bull case. Nuburu has only 19 institutional owners on file. That is an astonishingly low number. And those 19 institutions combined own less than 900,000 shares. The largest holders are Vanguard and Geode, which means the only institutional money in this stock is passive, index fund money that is forced to be there. There are no high-conviction, active management funds buying this story. To make matters worse, a 13G filing from July showed that one of its largest purported holders, Isosa Group LLC, had completely